Hey everyone, welcome back to Corporate Decoder, the place where we unlock the secrets hidden within your favorite companies. Financial filings, get ready because Cathay General Bancorp has just dropped their latest report, and let me tell you, there are some interesting moves being made in the world of banking. This looks like a snapshot of Cathay General Bancorp's financial health, captured on the 30th of September 2025. We've got their consolidated balance sheet, statement of operations and comprehensive income, and cash flows all laid out for us. But as always, we are going to cut through the jargon and get to the heart of what really matters. So Cathay General Bancorp is a big bank holding company and they own Cathay Bank, the main banking arm. They also have some investments in affordable housing and some other fun financial entities. They've got a lot of branches spread out, in California, New York, and even a few international spots like Hong Kong. Alright, let's dive into the financial tables. First up, their loans held for investment totaled $19.9 billion as of the 30th of September 2025. That is up slightly from $19.37 billion at the end of 2024. This growth mainly comes from their commercial real estate loans, which saw a nearly 5% jump. Now that is a significant chunk of their business and shows they are actively lending in that sector. On the other side of the coin, their deposits jumped by about $835 million to reach $20.52 billion. That is a solid 4.2% increase. This means people and businesses are trusting Cathay with their money, which is always a good sign for a bank. Now check this out, their provision for credit losses for the third quarter of 2025 was $28.7 million. This is significantly higher than the $14.5 million from the same period last year. They specifically mention an additional reserve of $9.1 million for 2 movie theater loans and a $3.8 million adjustment from changes in their financial modeling. This tells us they are seeing some specific weakness in certain loan types like movie theaters and are proactively setting aside more money to cover potential losses. It is like they are saying, hey, we might lose a bit of money here, so let's get ready. Their net interest income jumped by 12.1% to $189.6 million. Net interest margin also improved to 3.31% from 3.04% a year earlier. This is good news for the bank. It means they are making more profit on the difference between what they earn on loans and what they pay out on deposits. Think of it as their profit margin on money growing. And look at this, their efficiency ratio dropped to 41.84% from 51.11%. This is like saying they are getting more bang for their buck. They are spending less to generate the same amount of income. For a bank, this is a very positive sign that they are operating more efficiently. Now let's talk about the not so good stuff. Non-accrual loans, which basically means loans that are unlikely to be repaid, have actually decreased slightly by 2.1% to $165.6 million. That might sound good, but if you look closely, the percentage of these non-accrual loans that are secured by real estate has increased. This could be a sign that the real estate market might be a bit shaky, affecting their ability to recover their money if these loans go bad. And speaking of real estate, their other real estate owned, which are properties the bank has taken back because of foreclosures, has jumped by a whopping 43% to $32.9 million. This means more properties are ending up on their books, which is usually not a great sign as it can tie up capital and incur holding costs. But here is where Cathay shines. Their capital ratios are strong. For instance, their common equity tier 1 ratio is 13.17% for the Bancorp and 13.62% for the bank. These are well above the minimum required levels and even above what is needed to be considered well capitalized. This means they have a good cushion to absorb unexpected losses and can continue lending and growing. It is like their financial armor is really strong. Cathay also announced a new stock repurchase program of up to $150 million. They are buying back their own stock, which can signal confidence from management and potentially boost the stock price by reducing the number of shares available. They also completed a previous repurchase program around May and February if you follow along with these filings. You'll see this is a common strategy for companies. Now looking at this filing in broad strokes, Cathay General Bancorp seems to be navigating a complex financial landscape with a mix of strength and challenges. Their net interest margin and efficiency ratio are improving, which is fantastic, indicating they are becoming more profitable and running a tighter ship. Deposit growth is solid too, showing continued trust from their customers. However, the increase in their provision for credit losses, especially with those specific movie theater loans and the rise in other real estate owned, are red flags. These suggest they are seeing some specific stress in certain parts of their loan portfolio, possibly due to broader economic pressures affecting those sectors. The increase in real estate collateral backing non-accrual loans is also something to keep an eye on. The good news is their capital position is very strong. They have ample reserves to handle potential downturns, making them appear quite resilient. Their dividend policy has been consistent, but the limits on dividend payments tied to their subordinated debt are a detail investors should monitor closely. Overall, Cathay General Bancorp appears to be managing its business prudently with a focus on efficiency and capital strength. They are proactively increasing loan loss reserves where they see trouble spots, but some vigilance is definitely warranted on the real estate and specific sector loan front. Will they grow through lending and absorb the bumps, or will those specific sector issues create more significant headwinds? Only time and future filings will tell. Alright, that is our deep dive into Cathay General Bancorp's latest financial report. What do you think? Are these numbers a sign of solid growth or potential trouble ahead? Let me know your thoughts in the comments below. If you found this analysis helpful, give this video a thumbs up and subscribe for more in-depth looks into corporate filings. And hey, join our Discord community, linked in the description for even more exclusive content and discussions. Thanks for watching, and we will see you in the next video.